Preparing for a financial analyst at Deutsche Bahn interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial analyst at Deutsche Bahn? I am attracted to Deutsche Bahn because financial analysis here supports both commercial performance and essential mobility infrastructure. The business combines rail operations, logistics, large capital projects, and public sector responsibilities, which creates meaningful analytical challenges. I would bring strong Excel, accounting, and data interpretation skills while learning the operational drivers behind revenue, punctuality, capacity, and maintenance costs. I also value the opportunity to translate financial information into decisions that improve efficiency, investment returns, and customer service. While answering, connect your analytical skills to Deutsche Bahn's transport mission, infrastructure investment, operational complexity, public service role, and need for disciplined financial decision-making across a long-term capital-intensive business. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows profitability through revenue, expenses, and net income. Net income flows into retained earnings on the balance sheet and begins the operating section of the cash flow statement. The balance sheet presents assets, liabilities, and equity at a point in time, while the cash flow statement explains changes in cash through operating, investing, and financing activities. For example, capital expenditure reduces cash and creates an asset, which is then depreciated through future income statements. Make sure to cover the income statement, balance sheet, and cash flow statement, explaining net income, working capital, depreciation, capital expenditure, debt, retained earnings, and the importance of reconciliation. Question 3. How would you analyze Deutsche Bahn's revenue performance? I would decompose revenue into volume, price, and mix. For passenger operations, I would examine journeys, average fare, route capacity, cancellations, and seasonal patterns. For logistics or infrastructure-related activities, I would assess shipment volumes, contractual terms, utilization, and customer concentration. I would compare actual results with budget and prior year, then investigate whether movements reflect pricing, demand, service disruption, or portfolio changes. Finally, I would link revenue findings to margins and cash conversion rather than viewing growth in isolation. In your answer, talk about passenger volumes, fares, freight activity, contract revenue, regional and international mix, pricing, capacity, seasonality, variance analysis, and separating volume, price, and mix effects. Question 4. What financial KPIs would you monitor for a railway company? I would monitor both financial and operating KPIs. Financial measures include revenue growth, EBITDA margin, EBIT, free cash flow, capital expenditure, net debt, and interest coverage. Operational measures might include passenger journeys, train utilization, punctuality, cancellations, energy cost per train kilometer, maintenance cost per asset, and freight volumes. The key is understanding relationships. Poor punctuality can reduce demand and create compensation costs, while high investment may temporarily weaken cash flow but improve capacity and long-term reliability. Be sure to mention revenue growth, EBITDA, EBIT, free cash flow, net debt, investment spending, passenger volumes, punctuality, utilization, maintenance costs, safety, and unit economics. Question 5. How would you build a budget for a Deutsche Bahn business unit? I would begin with historical actuals and identify operational drivers rather than simply applying a percentage increase. I would forecast passenger or freight volumes, fares, staffing, wages, energy, maintenance, financing, and planned investment separately. I would validate assumptions with operational managers, challenge inconsistencies, and build base, downside, and upside cases. After approval, I would establish monthly variance reporting, explain deviations, and update the forecast when demand, costs, regulations, or project timelines materially change. Focus on driver-based planning, historical performance, operational assumptions, labor and energy costs, maintenance, capital projects, headcount, inflation, scenario analysis, stakeholder challenge, and monthly monitoring against approved targets. Question 6. Describe how you would investigate a significant unfavorable variance. I would first confirm the variance is real, correctly classified, and material. Then I would split it into volume, price, mix, timing, and one-off components, comparing actual data with budget and prior periods. I would speak with the responsible operational team to validate the business explanation, such as higher energy prices or delayed project milestones. Finally, I would document the root cause, quantify the expected full-year impact, recommend corrective action, and monitor whether the issue repeats. Make sure to cover materiality, timing, volume, price, mix, accounting classification, root cause analysis, management discussion, corrective actions, and distinguishing one-off effects from recurring performance issues. Question 7. How do you distinguish EBITDA, EBIT, and free cash flow? EBITDA measures earnings before interest, tax, depreciation, and amortization, so it highlights operating performance before non-cash asset charges. EBIT includes depreciation and amortization and therefore reflects the cost of using long-lived assets. Free cash flow generally starts with operating cash flow and subtracts capital expenditure, showing cash available after maintaining or expanding the asset base. For Deutsche Bahn, EBITDA can show operational strength, but substantial rail investment means free cash flow is essential for assessing financial sustainability. In your answer, define each measure, explain depreciation and amortization, capital expenditure, working capital, financing flows, analytical usefulness, and why EBITDA should not be treated as cash generation. Question 8. How would you evaluate a major rail infrastructure investment? I would evaluate the project using incremental cash flows, not allocated historical costs. I would model construction spending, financing, maintenance, additional capacity, fare or access revenue, operating savings, and residual value over the asset's life. I would calculate NPV and IRR, test payback, and run sensitivities for delays, inflation, demand, and cost overruns. I would also assess non-financial benefits such as reliability, safety, emissions, and network resilience, clearly separating commercial returns from broader public value. While answering, cover strategic objectives, incremental cash flows, CapEx timing, operating benefits, NPV, IRR, payback, risk, capacity, reliability, public benefits, funding, and sensitivity to delays or cost overruns. Question 9. What is working capital, and why does it matter for Deutsche Bahn? Working capital reflects short-term operating assets and liabilities, commonly receivables, inventory, and payables. It matters because profitable activity can still consume cash if customers pay slowly or maintenance inventories rise. I would analyze days sales outstanding, inventory days, payable days, accruals, and seasonal movements by business unit. At Deutsche Bahn, I would balance cash improvement with service reliability and supplier relationships, because excessively delaying payments or reducing critical spare parts could create operational and reputational costs. Be sure to mention receivables, payables, inventories, accruals, contract timing, operating cash flow, supplier terms, maintenance materials, seasonality, and avoiding actions that damage service quality or supplier relationships. Question 10. How would you forecast cash flow for a capital-intensive transport business? I would build a monthly cash forecast linking operating assumptions to collections, payroll, suppliers, taxes, maintenance, and investment payments. Capital expenditure would be phased according to procurement and construction milestones rather than spread evenly. I would include interest, debt maturities, leases, and committed obligations, then reconcile the forecast to the income statement and balance sheet. I would maintain downside scenarios for demand weakness, energy inflation, project delays, and cost overruns, with clear liquidity triggers and actions. Focus on operating cash drivers, working capital, maintenance and expansion CapEx, project phasing, debt service, tax, liquidity buffers, scenario analysis, and reconciliation to accounting forecasts. Question 11. What accounting issues are particularly relevant to Deutsche Bahn? A railway group has significant accounting judgments around property, plant, and equipment, useful lives, component depreciation, impairment, leases, provisions, and project costs. Revenue recognition can also differ between passenger services, logistics contracts, and infrastructure arrangements. I would review the relevant International Financial Reporting Standards policy, understand management assumptions, and assess consistency with supporting evidence. The analyst's role is not merely recording numbers, it is identifying how accounting judgments affect performance, assets, covenants, forecasts, and investment decisions. In your answer, discuss property, plant, and equipment, depreciation, impairment, leases, provisions, grants, revenue recognition, financial instruments, and the need to apply International Financial Reporting Standards policies consistently across businesses. Question 12. Explain how depreciation affects financial analysis. Depreciation allocates the cost of a long-lived asset over its useful life, reducing EBIT and the carrying value of the asset without an immediate cash outflow. It is added back in operating cash flow, but that does not make it economically irrelevant. A railway must eventually maintain or replace infrastructure in rolling stock. I therefore examine EBITDA and cash flow alongside EBIT, depreciation rates, asset age, replacement capex, and whether reported earnings reflect the true cost of operating the network. Make sure to cover depreciation as a non-cash expense, asset consumption, EBIT, EBITDA, cash flow, capex replacement needs, useful lives, residual values, and limitations of ignoring depreciation. Question 13. How would you assess whether a cost reduction initiative is effective? I would establish a clear baseline and define the initiative's owner, timing, and measurable target. Then I would separate recurring savings from one-time benefits and confirm whether the reduction appears in actual financial results rather than only in forecasts. I would monitor implementation costs, staffing, maintenance, punctuality, safety, and customer outcomes to ensure savings do not damage operations. I would also test whether costs have simply moved to another department or period before reporting the initiative as successful. Focus on a verified baseline, recurring versus one-time savings, implementation costs, operational KPIs, service quality, employee impact, cash realization, ownership, and avoiding savings that merely shift costs elsewhere. Question 14. Tell me about a time you used Excel or data analysis to solve a problem. In a university project, I analyzed monthly expenses for a simulated transport operator whose margins were falling. I cleaned the dataset, used pivot tables and SUMIFs to classify costs, and built a driver-based variance bridge. The analysis showed that an energy price assumption, rather than volume weakness, explained most of the decline. I validated the result against source data, presented a concise dashboard, and recommended scenario planning. That experience strengthened both my technical skills and my ability to explain analysis clearly. While answering, use a structured STAR example covering the business question, data cleaning, formulas or tools, validation, insight, measurable outcome, and how you communicated the result to stakeholders. Question 15. How would you use sensitivity analysis in a Deutsche Bahn forecast? I would first identify the assumptions with the greatest influence on earnings, cash flow, and liquidity, such as passenger volumes, fares, energy prices, wage inflation, capex, and project timing. I would test individual sensitivities to isolate impact, then combine realistic downside assumptions into an integrated case. A tornado chart can prioritize risks, while threshold analysis shows when decisions change. I would present the financial consequences and management actions, not just a collection of unsupported scenarios. Be sure to mention identifying key drivers, changing one variable at a time, combining downside cases, tornado analysis, probability considerations, decision thresholds, and communicating implications rather than producing excessive scenarios. Question 16. What would you do if operational managers challenged your financial analysis? I would treat the challenge as an opportunity to improve the analysis. First, I would understand whether we use different definitions, periods, or data sources. I would reproduce the calculation, verify the underlying transactions, and invite the manager to explain operational factors I may have missed. If the evidence supports a revision, I would update the analysis transparently. If not, I would explain the methodology and assumptions respectfully, documenting the conclusion and any remaining uncertainty. In your answer, emphasize listening, reconciling definitions, checking source data, separating facts from assumptions, explaining methodology, incorporating valid operational insight, and maintaining independent, evidence-based conclusions. Question 17. How would you analyze the financial impact of rising energy prices? I would quantify the exposure by linking energy consumption to train kilometers, fleet type, routes, and operating schedules. Then I would review hedging, fixed price contracts, customer pass-through clauses, and timing effects. I would model multiple price scenarios and calculate the impact on operating cost, EBITDA, cash flow, and fares or margins. Mitigation could include procurement changes, energy efficiency, timetable optimization, or selective pricing, while recognizing that service obligations may limit immediate operational flexibility. Focus on consumption volumes, hedging, contractual pass-through, route activity, timing, operating leverage, scenario analysis, mitigation options, margin impact, and distinguishing market exposure from efficiency opportunities. Question 18. What is the difference between a forecast and a budget? A budget is an approved financial plan, usually prepared before the year begins, that sets targets and resource expectations. A forecast is an updated estimate of what is now likely to happen using current information. I use the budget to assess performance against the original commitment and the forecast to support forward-looking decisions. If energy costs or project schedules change, the forecast should reflect reality, while the original budget remains useful for understanding accountability and planning quality. Make sure to distinguish the approved budget from an updated outlook, explain planning purpose, accountability, rolling forecasts, changed assumptions, variance interpretation, and why both views matter for management control. Question 19. How would you value a business unit or transport project? I would start with a discounted cash flow model based on operating drivers, margins, working capital, capital expenditure, taxes, and terminal assumptions. I would discount unlevered free cash flow using a risk-appropriate WACC and test terminal value carefully because it can dominate the result. I would cross-check the output using comparable company and transaction multiples, adjusting for capital intensity, regulation, growth, and leverage. Finally, I would present a valuation range and explain the assumptions driving it. In your answer, cover discounted cash flow, comparable companies, precedent transactions, forecast quality, WACC, terminal value, operating drivers, capital intensity, sensitivities, and limitations of valuation methods. Question 20. How do interest rates affect Deutsche Bahn's financial performance? Higher interest rates can increase borrowing and refinancing costs, particularly for floating rate or maturing debt. They also raise the discount rate used in project valuation, reducing NPV, and may affect the market value of fixed-rate bonds. I would map the debt maturity profile, fixed versus floating mix, hedges, liquidity needs, and covenant headroom. I would then assess both immediate profit and loss effects and longer-term investment consequences, rather than assuming every liability reprices simultaneously. Be sure to discuss borrowing costs, refinancing, bond valuations, discount rates, pension or lease effects, hedging, liquidity, investment appraisals, and distinguishing fixed rate from floating rate exposure. Question 21. How would you evaluate a public-private partnership or externally funded project? I would assess the project's full economic value and how risks are allocated between Deutsche Bahn, government, lenders, and private partners. Key items include construction cost, demand, availability payments, operating obligations, inflation indexation, guarantees, termination clauses, and lifecycle maintenance. I would model contractual cash flows and compare the arrangement with direct financing using NPV, risk-adjusted returns, and affordability. I would also involve accounting and legal specialists because contract structure can materially affect recognition, liabilities, and reporting. Focus on risk allocation, funding sources, contractual cash flows, availability payments, construction and demand risk, guarantees, accounting treatment, NPV, legal obligations, and value for money. Question 22. What steps would you take to ensure accurate monthly management reporting? I would follow a documented close calendar with clear responsibilities and deadlines. Before reporting, I would reconcile general ledger data to subledgers, review accruals, provisions, intercompany balances, and unusual entries, and confirm that project costs are classified correctly. I would compare actuals with source systems and prior periods, investigate material variances, and maintain version control. The final pack should combine accurate numbers with concise commentary explaining causes, outlook, risks, and required management actions. In your answer, mention data reconciliations, close calendar, system controls, accruals, intercompany eliminations, variance review, version control, materiality, documentation, and clear commentary for decision makers. Question 23. How can sustainability factors influence financial analysis at Deutsche Bahn? Sustainability is financially relevant because it affects energy costs, regulation, capital allocation, financing access, asset resilience, and customer demand. I would quantify emissions and energy consumption alongside investment and operating costs, then evaluate options such as electrification, renewable power, efficient rolling stock, and climate adaptation. The analysis should include lifecycle economics, not only upfront spending. I would also ensure assumptions align with reporting requirements and avoid presenting environmental benefits without explaining their measurable financial and operational implications. While answering, connect emissions, energy efficiency, climate resilience, regulation, financing, asset choices, operating costs, customer demand, reporting requirements, and measurable financial as well as environmental outcomes. Question 24. What would you do if you found an error in a report shortly before a deadline? I would quickly determine the error's source, magnitude, and impact on reported conclusions. If the report had not been distributed, I would stop release, correct the data, rerun relevant checks, and inform the responsible manager. If it had already been circulated, I would escalate promptly, explain the correction clearly, and follow the required governance process. I would then document the root cause and strengthen the control, formula, or review step that failed. Be sure to mention assessing materiality, stopping incorrect distribution, notifying the owner, correcting source data, documenting the issue, communicating impact, meeting governance requirements, and preventing recurrence. Question 25. What questions would you ask us at the end of the interview? I would ask which business decisions the team most needs the analyst to support during the next year. I would also ask how finance collaborates with operations, which systems and reporting tools are used, and how forecasts are updated. Questions about training, feedback, and progression would help me understand development opportunities. Finally, I would ask what distinguishes a strong performer in the role and which current financial or operational challenge is most important for the team. In your answer, ask about team priorities, analyst responsibilities, systems, development, decision support, current challenges, performance measures, collaboration with operations, and how success is evaluated during the first year. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.